Thank you very much, everyone, for joining us on our next Ripple Ventures Tank Talk. We have a special guest today talking about being a family office during the crisis and his operator-first approach to investing. Everyone, please welcome Michael Hyatt, co-founder, president, CEO of BlueCat Networks. Michael, thank you so much for joining us. Nice and early work from home morning. Everyone, Michael Hyatt is co-founder of Hyatt Family Office, which is what we're going to be discussing today. Previously, he had started with his brother, BlueCat Networks, worked there almost 20 years. BlueCat, as most people have probably recognized, was acquired by Madison Dearborn in 2017. They were an enterprise DNS solutions company that enabled customers to build and manage their complex infrastructure networks. Before that, he was president and CEO of Diadem, founded in '93, and was acquired by IHS, a public company that trades on the New York Stock Exchange, in April 2011. On a personal side, Michael is a graduate of the Western University with a BSc in chemistry and biochemistry. He is a dragon on CBC's Next Dragons and a guest speaker on the CBC's Exchange and On the Money. He's also a founding member of Creative Destruction Labs in Toronto and the Founders Institute. He is on the board of Madison Dearborn and I believe as well on advisor to several large venture funds, especially Georgian Partners in Kensington. And he is chairman of the Hyatt Family Foundation, which focuses on science and technology. I guess everyone wants to understand, how do you approach investing as a family office, given your whole background being an operator and majority owner in your businesses?
So investing is a lot more boring than you think, and it should be. I think that there's this idea that you should be going out with the wealth you've created and just kind of like, investing in every startup and what have you. But the truth is that when you have a family office, you're in the wealth preservation game. You're not in the rapid wealth game, and you just have to sit back and probably spend your day saying no and probably not investing in most things. Our family office has a very, very simple kind of return. We actually look for a blended across all assets around 8% a year. And by the way, that's not very far off. That's even higher than the big pension funds, which are probably 6 to 8%. The S&P over 20 years will give you 7 or 8%. Cash gives you 1 or 2%, and venture capital could give you more. And everything's barbell between those two. We spend a lot of time just looking at funds and looking at deals and not doing things because either we don't like the parties or the deal structure, what have you. But when we do a deal, we tend to write a bigger check and we go kind of all in. We actually back people consistently. And we spend a lot of time trying to get to know the people that we're investing in. I'll give you the basic breakdown of what we do. Our asset allocation is probably a third in the public markets, probably a third in real estate, and probably a third in private equity, which includes venture capital. We're not quite there yet. We're taking years to try to get that asset allocation. And if you look at that allocation, one does good, one does not good. It depends what year you're in, but it blends up to a nice return.
Gotcha. And so I guess that a third approach was something that you were guided towards, or just something that you felt comfortable with? How did you guys settle on that?
I have a partner named Elmer Kim, who you probably see me on TV with for 10 years, but he's our chief investment officer, and he knows more about this than me. And that's one of the first things we ever did and always did in software. We always partnered with people that were smarter than us that helped to guide us. And he's very, very good at it in private equity. So he would take kind of these kind of cowboy entrepreneurs like my brother and and I guess I'm more of a cowboy than my brother, and basically tell us to sit on our hands and figure out the allocations. But, look, I'd love to tell you that, investing is the most exciting thing in town, but it's a lot of doing nothing and a lot of being very patient, especially in this market today.
Yeah, well, we'll get into the market today as it stands shortly. I guess, so how has the impact of COVID change your investment strategy, whether the industries you're focused on, portfolio allocations, and sectors? And feel free to go into what you feel about the market right now due to COVID as well.
For all the founders and everybody's watching this right now, if I spoke to you in November, December, January, cash was trash. Cash was trash unless you had your cash working for you. For the past 10 years, if your cash wasn't doing something, it was trash. On or about March 15th or March 8th, something around there, cash went from trash to king, cash king, like in like 3 days, a week. And we were really struggling over the past 2 years to invest because we just found a lot of things too expensive. So we were sitting on a lot of cash. So we were very lucky to take advantage of the market. And there was a massive dislocation that occurred. With COVID, it was very much like a 9/11, which was the planes hit and something suddenly happened. It wasn't like 2008 where you had a global kind of a banking crisis and a liquidity crisis and something you could kind of get your arms around, which is, okay, if I take this many houses off the market and buy these dirty bonds, I can probably fix it. And it took 2 or 3 years to fix that 2008 problem. This was a sudden impact. People had revenue on March 15th and March 16th. They didn't, kind of thing. It was a shock to the system. We did a lot of sitting on our hands and watching, but we realized one thing, that the public markets became an extremely good place to put money, because it was almost a once in a lifetime buying opportunity. And we immediately realized that. So were we buying down when the S&P was 2,200 and all that? Yes, we were. We were buying companies where, you know, we didn't always pick the bottom. We certainly bought things that went down and what have you, but we're dramatically up. But we certainly saw it as a time where we'll get past this problem. And if you listen to past podcasts in the past 3 months, and isn't it crazy? Like 3 months ago feels like 3 years ago. Yeah. but we were saying that we will get past this. You just had to figure out when we'd have therapeutics or when we'd have a vaccine and the world would come back, but it would come back very different. And right now, what's really interesting is the kind of, if I did this podcast a month ago, it was, did you buy Peloton? Did you buy the stay-at-home stocks? What are you buying now? Get out of your house stocks. Actually, you know, I'll tell people what I'm buying right now. I've been buying airline stocks like Delta and, you know, United. And I'm not giving advice, by the way, but I've been buying get out of your home stuff because I think the world is going to open back up eventually. It's not going to be pretty for a while, but the world is going to open back up. So we've gone from the, you know, not coming out of the house Peloton phase to maybe I should actually do something phase. And I think that'll just keep getting better. I'm overall very, very optimistic on the economy, on the world we live in, on the way technology is going. I'm very, very bullish on anybody out there who's just starting a company right now. This is an incredible time to start a company. I would advise you to start a company today. These are where great companies are started because the bad news is baked in. You know, you've seen the accident, right? You're sitting in there, it's bad. And, you know, so if you started a restaurant today and you could do well today, theoretically, you'd have a very good thing. So if that's what you wanted to do, and I wouldn't necessarily recommend that yet, but it's a very, very interesting time in the market. You know, most great companies were started after these kind of disasters.
So industries that you're really excited about, obviously starting businesses, I assume you mean tech businesses, digitally enabled businesses, or what kind of businesses?
I think there's great themes. So what happened, and if you take a look at, we at Georgian did an investment in Top Hat again this week, or just recently, because they're buying publishers and what have you. You're looking at companies that, what's actually happened, what you're witnessing is what normally would have taken, if COVID never occurred, the global digital transformation would have taken 7 to 10 years, probably, something like that, 5 to 10, pick a number. It just went bang to 12 months, right? Yeah. And we all know it. And so, you know, you and I are quite similar, Matt, where we have investments, we're out there, and our investments did two things. It's a barbell, either no revenue or incredible revenue. It was really people then, and then the no revenue is pivoting and they're trying to figure it out. Like we have, you know, incredible companies with incredible founders like Ritual. Great founders, great team, but, you know, they could never have known that, by the way, wake up and by the way, all your customers get shut down. That was something that was unknowable. But, you know, you have a great team and the pivot's, you know, working and they're doing well. And on the other side, you have like these COVID winners like Top Hat, which is, oh, by the way, that digital transformation at every school, that needs to happen right now, not in 7 years. Everybody go. And then they started to acquire, you know, these publishers. And so there's this very barbell approach to what's going on. And and that's what we're in right now. We have the kind of COVID accelerators and the COVID companies that have been kind of T-boned and have to pivot their businesses. Mm-hmm. and the great entrepreneurs as well. And this is where creative destruction comes in. This is where the great entrepreneurs are born. The ones that are, because look, in the past 10 years, everybody watching this, look, it was easy to get money. It was easy. Everybody had money for you. Money was cheap. Money's free. Interest rates, which are the price of money, have been super low for a long time. Everybody has a fund. You can get money. You can do, everybody just starts a company. And let me guess, your pre-round money or your seed is 4 million. Then you go to 8. And then everybody is doing the same thing. COVID hits, the tap stops, cash is king. The real businesses and the real entrepreneurs are born now. where this gets very, very difficult, because if you can raise money now and you can get something going, let me tell you, you've got something. It's a very, very different thing.
Yeah, it's interesting. The companies that were a part of a digital transformation that had already happened, like in travel, hospitality, restaurants, they seem to be the ones who are getting really hit because they had so much growth behind them because their industries picked up a lot of the digital transformation. And
Right.
the ones that were slower to adopt, construction, education, real estate, they're actually the ones benefiting the most because they didn't have this pre-COVID rush to their services. And now people are all of a sudden turning it on. And I guess with high growth, comes high valuation, high capital injections, things like that. So it's an interesting dynamic. I don't think there's a correlation between them, but it's just sort of the way they played out. So interesting to hear that from you as well. I guess you work closely with Georgian and Kensington. How are you thinking about venture capital post-COVID? What do you think those guys in some other venture fund should be focused on?
The folks at Georgian are so smart. I mean, I don't know if you know how Georgian does things, but they basically have stuff that just other VCs don't have. They have a full coding team. So if you get money from Georgian, they actually give you software that they're coding, which is extremely useful. They have a whole SWAT team that comes in and actually helps you with all your big data and your dynamics and your security. So, you know, Georgian's got to the point where when you go to a board meeting in the US, or typically in the US, they'll actually have slides in their board meeting say what Georgian did for us this quarter, which I've never seen before, because we're literally helping them with SWAT teams and doing stuff. But Georgian has this incredible, Georgian by happenstance happened to raise 850 million right before COVID. So they have all this dry powder. So now the companies they're investing in, this would be a good time. I mean, if you have a lot of dry powder, and Kensington has powder too, and what have you, and if you have dry powder, you can, if things you can buy right now, it's phenomenal. Because look, it's kind of, I don't know if I could really look at people's revenue before March. So the further I get away from, if you can show me 1 quarter after March of scale and growth and everything's going well, or 2 quarters, you and I both know, Matt, like this could be a really good investment. Like if you're thriving right now,
yeah,
like this is a pretty good indication that something's going on. I mean, you know, I have a company I invested in called Second Closet. They do B2B storage logistics, like a small XPO type company. And, you know, it exploded at COVID because, you know, whoa, everybody's, you know, delivering and shopping online. And most online retailers are moving up hundreds of percentages, and they needed all the logistics and all the pick and packs. And so I think that, you know, what you're seeing is this incredible dynamic, where if you have money right now and you have a way to place it, and if you can show growth, wow, I mean, you are going to be a winner. Because imagine when the world comes back, right? How good you're going to be doing, right?
So if you could show revenue during March and April, May, that's the place you would want to put your money on a company.
It'd be a great indication.
Yeah,
look,
for sure.
Here's a secret to investing that I've learned. It's really, really simple. If we look at all the investments we've ever made, and I think we're invested in something like today, like 47 tech companies as an example. We're invested in companies that are not tech. We're invested in real estate, right? But if we line up every single investment we ever made and said there's one correlation, there's only one correlation that's almost 100%, it's great founder, great outcome. That's it. Or great CEO, great outcome. That is the number one correlation. And every time we have a problem, it was mediocre, not so hot. They didn't listen. They didn't take advice. They had no humility. They didn't treat their people that well. They did the wrong things. They were trying to, you know, game the system. Not so great outcome or bad outcome. And so the correlation between finding great people that you can work with, that can listen and you can debate, that's so key. So if I found a founder who will listen and I can debate, because I'm happy to say, you're right. I'm actually wrong on that. Okay, let's have a debate. If you're coachable and we can talk, and you have humility and you're open to doing the right things for the business, and you're a great founder and you listen and you can pivot, because all businesses need to pivot. No matter what, you will pivot. I don't know what, you're going to pivot. You're going to pivot 3% or 75%. Facebook's a pivot. Google's a pivot. They're all pivots, right? Even Microsoft, as incredible as they were, had to pivot to the cloud at one time, right? From the desktop. So all great businesses pivot. And can you pivot? Because that's what we're betting on, your ability as a leader to pivot your business and your people. And there's that massive correlation. So if I found a company that was scaling on revenue, that's okay. But if I found someone I could really work with, that's what I'm interested in. Because it's a marriage, right? I could be in that company for 10 years. I want to like the person. I want them to listen, you know?
Yeah, that's really, really good feedback. So I guess what is your view on alternative assets when it comes to diversification or hedging strategies, gold, real estate, crypto, as an investor yourself?
So the thing about the stock market is that every day, everything's getting priced right in front of your eyes. And you either get excited or wigged out and you have FOMO and, oh my God, maybe I should have bought this more or that. That is actually happening to private assets and VC and private equity, but we're just not marking it to market on a minute-to-minute basis. And if we did, we'd have the same effect. But thank God we don't, because we have to save ourselves from ourselves. So if we want to invest, we have to be able to invest and not get so wired up all the time on price. I think that to have a diversified strategy, you need a number of what they call liquid structures in private equity and venture capital, what have you, that save yourself from yourself. Because, you know, there's plenty of people, if they could sell their private assets when they were freaking out about COVID, would have sold everything at the bottom, which would have been probably the wrong thing to do. So I think that having a number of, you know, it's funny, if you take a look at the last horrible recession in 08, 09, if you had a private asset that crashed in 09 and you just went to sleep and woke up in 2011, you were up. All you had to do was go to sleep. But can you go to sleep?
Right.
So I think they're required. We have a lot of them. We still get paid. Everything's going fine, and it just moves to the market. It's approximating market. But so when the public markets are down 20%, the private markets are probably down 30%. You just don't know because we're not out there doing it. Does that make some sense? Like,
yeah, for sure. They can ride the wave better.
Yeah, but now the market's back up to today, S&P 3,100, 3,000, you know, and things have come up. All the tide rises all boats as well. So,
Yeah, but
similarly, you would have a massive write-up.
Do you think, though, that the public markets are a really good indicator of Main Street these days? Because everyone keeps thinking it's totally dislocated. I mean, 50% of the S&P is all IT now and tech. And so is that, you know, representative of the entire economy? Probably not.
No.
So using that as a bellwether is not a good asset anymore.
That's right. The stock market is good for big companies. You know, when the Fed comes out and pumps cash in and buys bonds, that's great for big companies. And they do really, really well because they can figure that out. They have resources. Listen, as we're having this conversation, if you just didn't know any facts, you just looked at the stock market indications, you wouldn't know that we're having this conversation today in the worst quarter since the inception of the United States. In 1776, this is the worst quarter ever on record at negative 35 GDP. If I had a beer with you last year and I said, hey, next year, we're going to have a negative 3% GDP quarter, you said, I don't know, that's hard. If I said we're going to have a negative 10, you'd say, no, that's impossible. Negative 35, you would have bet anything that's impossible. Mm-hmm. Negative 35 is so extremely high. And of course, we're probably going to have a bounce in the coming quarters as the market reopens. This is a forced closure. The problem is we still have 40 million Americans and probably more out of work. We have millions of Canadians out of work. And what you're witnessing right now is effective and ineffective government. You know, what Canada has done really well is get that CERB money out to people. We just said, just get it out, get the money out. And you know what? That is relatively saved us. It's going to have a big tax bill later on for us, but we've kind of saved everybody because we said, hey, you got to shut down, you can't work. So our social system has actually worked well. In other countries like Sweden and Germany and South Korea, it's worked well. Other countries have had a very hard time getting money out to people. Main Street in the US is very, very broken. Infrastructure products are broken. It's such an incredible country, but they have such strife between the two parties right now. It's so difficult to get things done. It's so different to get money out to Main Street. One of the reasons you have so much protest about opening up Michigan is that there's not enough money getting out to the people at the base. There's no CERB there. So people are rightly getting panicked because they have no money, right? And imagine if Canada had no CERB or had no way to 75% in income. Look at the UK. The UK has supported incomes by 80%. That's why you don't have the unemployment. Unemployment in the US is crossing 20% today. And that's the number coming out of the administration. The stock market has nothing to do with Main Street in a lot of ways. And it's an incredibly painful time for both countries. I just think Canada is figured out a way to soften that blow. And the question is when that store reopens and laid off 17 people, did they hire back 15 or 17, or did they hire back 3 or 6? I think it's going to start off with a very few people. So I think we're going to have stubbornly high unemployment for a while.
Well, you're seeing companies raise capital and lay off people. So
Right.
we're, you're trying to say, are you struggling, or are you just using this pandemic as an excuse to level up your team, which
Uh,
happens in all pandemics or all sort of crises and stuff. But
that's
I
right.
see your point. So, okay. So how does your family office think about wealth preservation versus wealth creation? We talked about this in the beginning. A lot of North American family offices are more focused on growth. Do you fall into that category, or are you in the preservation side, or kind of a hybrid?
Everybody's in the wealth preservation game to some degree. I mean, you would think by my public profile that I'm out there doing startups all the time. I am, but it's actually very few because I actually have to. It's not the money; it's the fact that I have to have a ton of meetings and put that in. It's like a big energy thing. Like I spend a lot of time with Second Closet, for example, with the CEO. So it's an issue thing. So we do a lot of investing in a lot of very boring real estate, debt asset structures that we just get paid every month on. Here's something I'll tell you about your life. And I think the Rich Dad Poor Dad book, which I haven't really read, but the concept comes from there. It's like that, assets, anything that pays you is an asset. Anything that you pay is a liability. Theoretically, your home is a liability, not an asset. But your bonds and stocks that pay you, dividends and what have you, are assets. So the way you want to think about your life is whatever money you have left over, buy things that pay you when you sleep. So how many things do you have between renting out a condo to somebody, or a bond, or a stock with dividends, or what have you, or you have you're in a fund that has a structure that pays you quarterly or monthly? How many things pay you as you sleep? That's how people get wealthy. They live below their means and they get paid while they sleep. That's how people get wealthy.
Gotcha. We have a question here for you. How are you thinking about sustained higher unemployment rates? Do you anticipate consumption to bounce back to 100% of pre-COVID levels? If not, what industries interest you in a lower demand environment?
Unemployment will remain, in my view, stubbornly high for longer than people think. I think that our country and a lot of places have to figure out how to dramatically shift the demographic of what people do in this new economy. We've seen a consolidation of power in tech, in healthcare, and places like cybersecurity, like a big, very hot places. I think that we're going to have to rethink the whole employment situation very, very carefully. I'm most worried that until there's a vaccine, for example, we can't fully open up restaurants. Like, how do you take a restaurant and say to the owners, yes, you can open, but only 50% of the tables? Well, they're not profitable. They can't make enough money. So we certainly can't go to a movie theater. We're certainly not going to go to that NBA game. And I love going to see the Raptors. And think about what happens when like 30,000 people go to a Raptor game. Everybody goes out for dinner. Everybody takes an Uber. There's so much ancillary revenue going on there. That all goes away, right? So there's so much of a ripple effect. And so, I think the short answer is when you're going to see things get better is, the vaccine comes out. So the vaccine comes out maybe first quarter if we're lucky next year, and then it takes up to 6 months for everybody to get it. I mean, we're talking, you should be prepared to hunker down into 2021 right now.
Gotcha. Yeah, I think that's true. And I think also, the retooling of unemployment, people was going to take time, no matter if COVID happened or not. And now it's happening at lightning speed. And I just agree with you that you can't have unemployment go from, 20% back down to normalized levels of 5 to 7 so quickly, because all these people were let go and they were being replaced by AI. And
but there's something that's
learning.
let me give you something I think is going to happen. Here's my estimation. I want to throw it by everybody listening. I think manufacturing is going to leave China, and maybe it goes to Vietnam and some other places, Cambodia, whatever. But I think people will be more interested if you make something in Canada or America. I think if you figure out a way to do that and share the profits and figure out how to do it with workers here, I know that's challenging. I think people are going to want that. I think there's a relative mistrust of China right now based on what's happened. And I think people are going to want to hear that you're making things here.
Yeah. I mean, that was a big part of our investment thesis in our newest company, Rose Rocket, the re-onshoring of supply chains. People not trying to rely on one supplier, diversifying. And I think that's going to happen not just only in supply from overseas, but also supply of income. Maybe people don't want to have only one source of income from one employer, but diversification of income.
all of us have benefited from the cheap stuff we've gotten at Walmart and whatever that's come from China over the years. It's been incredibly there's been a lot of wealth creation because we paid less for things and we benefited, we have more money in our pockets, but really we've paid for that in a different way.
Yeah.
And I think that's going to change. There's a question here asking about startups. How long should a runway be planning for? Maybe I'll answer this question. So if you have a startup today, how much money should you have for a startup? So about 2-3 months ago, I did some podcasts and I told everybody that they should have runway till March 31st, 2021 minimally. And you have to be super careful. I actually told everybody that this quarter union expects 75% less revenue and the next 2 quarters, 50% and then 25%. So you scale down and come back up of what you thought your new sales would be. So you have some churn, you have some people that won't pay, you have 75% less people buying. You know, you could be the other way because you're selling hand sanitizers or something somebody wants and you might be doing better. There are people that are doing better digitally for sure, but not everybody's digital. 3% of Canada's economy is tech. So I think that right now it's very hard to raise money unless you're known, because it's very hard to get out and meet people and do that stuff right now. You should have as much runway as you can. I told people to draw their lines of credit, but I would be a lot more careful with your burn and spending unless you're accelerating your revenue right now. You know, a company that's growing at, you know, cash negative and it's only growing 20% a year or whatever, I think you're going to be very challenged unless you're at scale. That's very difficult. So cash is king and you're at war, and you have to be a wartime CEO today versus a peacetime CEO. The past 10 years, you're a peacetime CEO. Nothing's going wrong, free money, tons of COVID hit, wartime CEO. You've got to change the way you think. You've got to change how you're going to spend. Hope is not a strategy. You've got to start using Excel a little better and start being less optimistic on your planning going forward. And if you beat your numbers, great. But you should try to figure out how you're going to get well into 2021 with not much more cash.
Well, that leads perfectly into our next section of questions on the operator approach to investing. So I guess, how does your operator experience affect your decisions to invest, and what kind of founders do you look for when investing?
I want to like the founders first. I don't want to work with people I don't like. I mean, I've earned the right not to work with people I don't like. And what I mean by that, I want somebody that I want to invite to a barbecue that's going to do the right things. I want to, you know, and I want to trust them to almost the level of babysitting my daughter. Like, I'm serious. Like, I really want to, I want to feel good. I want to like you. I want to trust you, because it's not worth it to me to just be in business with you for 5 years if I don't like you. 10 years, I'm not into that. I want to like the person. I want to trust them. I want to argue a bit, and I want them to make a point, I to make a point, and then we can figure out the best answer. I want them to be humble. I want them to be open. I want them to be kind. I want them to do the right thing. I don't want to hear them disparage their staff or their clients. I want them to be, you know, ruthlessly focused on bringing the company up the hill. But I'm most interested in the relationship that I have with founders, and are they that, you know, Jim Collins writes an incredible book called Good to Great, and everybody here should read it. But he describes, you know, the best leaders are people that are less flashy, that are more introverted, that think more, that, you know, that he, you know, this idea that you have to be this kind of snazzy CEO snapping your fingers all the time and just being very colorful is really not the thing. You have to be very thoughtful. You have to be very pragmatic. You have to know your weaknesses. You have to know your strengths, and you have to only work on your strengths and hire your weaknesses. I'm really interested in, I'm very open to investing in people's businesses. So like, I have cash, I can do that. I like doing that. I like meeting great founders, but I'm looking for people that really have a way to take me up that hill, that there's going to be a way to scale this business, that you're open to it, that you do the right things. So there's a whole bunch of things in there, but I just can't, if I get past liking you, I'm not going to do it.
Yeah, it sounds like founder represents like 99% of what you're looking for in the beginning.
And then when I get past that, then I'll dig into the product and
right. Yeah,
right?
Completely agree. So what about your experiences from your past, and, you know, dot-com crisis, 2008 financial crisis, are you leveraging today to help your portfolio investments survive? So the founders you're working with, advice.
So I sat them down and I said, look, the next 4 quarters are going to be brutal. What do you think your revenue is going to be in next quarter, which is this quarter? And they would say, well, we might be down 30%. And I said 75. So if we can be fine at 75, and you know what, a couple of them I was wrong, but some of them were down 50. Some of that, you know, so we had to right size the company. We had to do this change, we had to do that change, got support from the governments. But we got away from the, this is just COVID, it's bad, but hope's a strategy. So I'm going to hope that everything's going to open up. I think when this really happened, don't you remember? Like, I think everybody thought by June we'd be open back up and everybody back, right?
Yeah.
You know, I'm thinking now more after Labor Day, things are 50 to 60% normal, but certainly not on, there's gonna be no large gatherings. I'm not sure this silly Trinity Bellwood Park thing shouldn't be occurring then either. Like nothing's gonna be normal by after Labor Day, but you know, the market's gonna be functioning again.
Mm-hmm.
But I demanded hope not be a strategy very early.
Any similarities that you can leverage from what you experienced building your last two companies during those times?
Yeah, cash is king now. I remember in 2008 or 9 wanting to raise money just because I did at BlueCat. And I remember in the trough of the liquidity crisis, I remember seeing what my valuation was, and my revenue was increasing and I was kind of break even. I was getting bids at 1x revenue.
Wow.
Yeah, but I mean, and listen, we weren't that small. We were still like, you know, we had many millions of revenue and we were in network infrastructure and we weren't in a bad space and we had a big fat gross margin. Our gross margin as a business was 80%. I mean, we were great. And yeah, people would be like, yeah, I'll give you 1x revenue. That's what happens in a peak of a liquidity crisis. That's what I mean when you know, the stocks dropped, you know, everything dropped all the way down. That's what I mean. Your private companies, if you really went out to value, if you went out to value your company in the trough, you would find the same thing, but people just don't think that way. So cash is king right now. And you should be it's going to get very expensive if you want to raise money and you're not in one of the barbells. Like, you know, companies like Top Hat can get in there and take advantage of this and actually say, look how we're growing and doing the right things. You know, companies that are getting paid for that performance in here. So it's very barbelled right now.
Right. So what is your strategy on helping bridge the gap between startups and large corporates? People want to know.
Meaning?
Just sort of like right now, startups are probably struggling to stay alive, but they're also trying to get large corporates to be their customers and partners. You know, why take a chance on a startup? So founders on the line are saying, I'm a startup, I'm trying to make my way here. How do I leverage, you know, bridging the gap from your experience when you were probably selling to corporates as a startup or partnering with them during a crisis?
Look, there's always a bull market. There's always a bull market, as Jim Cramer says, right? And let me tell you right now, plenty of corporates are buying plenty of things from companies. Maybe you don't have the right product, but the truth is people are buying. People are buying a lot of stuff right now. Are you in that priority? You don't compete against necessarily people in your own space when you sell to big corporates. You compete against everything they need to buy at that time. So I don't know, if you were selling ventilators 2 months ago, you were very popular. If you had 2 months ago, you had hand sanitizer, you were very popular, right? So if you have the right product at the right time, you know, those are extreme examples, you're going to do well. We're seeing companies that have amazing digital transformation products where people are like, oh my gosh, I need that product, right? So, and you have that in your portfolio as well. And people just, you know, need way better shipping logistics. Second Closet, a company I invested in. So it's like, there's plenty of companies doing well, but you need to be on the COVID side for the next 1 to 3 years of that to do well.
Right. Know your value proposition and hone in on that, and don't try to force it onto someone who's probably focused on something else right now. So
if you have a business plan on March 14th, it's not relevant on March 15th of this year. After COVID, your business plan doesn't matter as much. You have to actually pivot it to accelerate it or change it completely.
So what would you say to Ritual then? Just wait it out or pivot?
No, Ritual pivoted. They're coming out with a whole bunch of new things. And I think they've got an incredible CEO and they've got a great founding team. And, you know, I mean, you know, certainly they weren't in their board meetings last year saying, hey, one of the scenarios we should write down is like 100% of our restaurants closed down for 6 months. Like that's not a scenario. So when they get hit by, they get T-boned, they're pivoting the software. They're doing a ton of things. I think they've released, so I don't want to talk out of turn because I know I'm not sure what's publicly divulged, but they're pivoting. And this is exactly it. So I bet Ray and his team make it. And I think they do really well. Why? Because you got a 5-star CEO and you got a 5-star team and they will make it through. And so real leadership, actually Ritual started on March 15th. It never started before. This will prove the leadership. And I put more money in and I was totally bullish on them. But the pivot there is when that company eventually has an exit, the story will be like they're doing before COVID, they're doing this, right? Then they have this problem, and then it's the pivot. This is what I think will make them exceptional,
Right.
right?
Good founders can, always look good when the tide is rising. Great
Yeah.
founders go faster when the tide falls back.
Listen, it was easy to take a victory lap in the past decade. In the
Right.
past 5 years, I mean, everybody could grow something. Everybody could have a higher valuation because, I don't know, you tell me. I mean, that's what was happening, right?
Yeah, absolutely. So, what advice do you have for family offices that are looking to make investments into venture capital for the first time?
Uh, don't do it unless you invest in a venture capitalist that you can trust. Look, it's very, very difficult to invest directly into a company. I love investing alongside a venture capitalist because 5 years from now, if you're not on the board, that VC is, and that VC protects my rights and my share class in 5 years from now when all the parties are over. Because everything's very different in years from now from when you invest, right? I know when you invest, there's a big party, there's a closing dinner, and there's a rooftop patio party. But who's protecting my share class interest in 5 years from now when everybody's forgotten about that? That VC. So I spend time co-investing with Whitecap and Golden Ventures, and just started to look at deals with you. You got some excellent things for sure, and I'm happy to do that. And I think that I really like having a VC because the VC adds a level of due diligence, and they add a lot of the tough terms in there that make it so that we all got to be aligned in the same boat. So I think direct investing is a very hard thing to do. I will direct invest and go into a fund. I like writing in a check, but also like being invested in the VC and go alongside the VC. So I have people looking at it, people bringing more resources to the table. So I don't typically like to do it on my own as much as you think.
No, that's great advice. And I think a lot of our family office investors are of the same view. A lot of them have, real estate investments, public investments, but spending day-to-day direct investing is just not something they focus on.
It's
It's
a
hard to
lot
do.
of heavy lifting. You don't want
Yeah.
to do the paperwork, and you don't want to follow up, and you want to be, on the advisory board, maybe get alongside. But I love having VCs as partners. There's a lot of good ones in Toronto. And believe me, I argue with them. Like there's been times where I go in at the end of the day and they don't, or vice versa. I mean, I love the tension.
That's great. Thank you for that. All right. Well, I mean, that was the rapid rundown with you not seeing any of those questions, Michael. So kudos to you for doing that on the fly. We'll leave it open to see if there's any questions in the chat for the next minute or so. It looks like we have a question here in the health tech space. We're seeing increase in revenue month over month. Should I still be conservative with my spending or aim to spend higher for more growth given the uncertainty if you're in the health tech space?
Look, I don't know enough about your business. I have 47 other questions to ask you, but if your revenue is increasing right now and your gross margin isn't decreasing, so you're not buying market share. So that's a really important thing. You're not lowering your price, having a lower gross margin just to buy market share. If you're growing nicely and you're not bleeding too much cash, I would invest more and grow faster. Because the market pays for growth at approximately at a 2 to 3 times valuation than profit. There's something that you guys should all know about, guys and girls should all know about, the rule of 40 or the rule of 50, which you take your growth rate and you take your bottom line. So if you're growing at 30% on the top and you have 10% on the bottom line, that you're a rule of 40 company. But it's better to be growing at 30% than at 10 and have 30 on the bottom, right? Because you pay for the growth. The growth is the more exceptional thing. But if you're accelerating and growing right now and you're not bleeding incredible amounts to get there, then I would double down, partner with a VC, add more capital and grow. But I don't know what your growth numbers are and your metrics are. Be very cautious of the user economics. Be very cautious of your gross margins. Great tech companies need above 70% gross margins. That is key. The best ones in the public exchanges are above 80.
Very good advice. I have one question for you. I think, we're 11 years removed from the last crisis. In the last crisis, there were people looking to sell businesses as retirement succession planning, strategies. They missed the boat on that. They had to rebuild their business for 10 years. Now they get hit with another crisis. There must be a ton of succession planning opportunities out there for investors like you who are operator investors. Are you seeing a lot of retirement businesses for sale? A lot of people just trying to get out because they don't want to pay another 10 years into it?
So our thesis is that's going to start happening in September more, because people eventually have to meet. Look, everybody probably had enough cash to get 1 or 2 quarters, but we think their real trouble starts a little later on.
Right. Yeah. In our last podcast with Chris Rasmussen, founder of Doxum, he said the worst part of the crisis is always 9 months after.
Yeah, he's right. I threw it at, he's probably right. 6 to 9 months. Yeah, I agree. Yeah, he's right.
So you mentioned digital transformation in, the ed tech space. What other trends and industries are you seeing it happening right now? You say, logistics, re-onshoring, obviously healthcare, other areas you're really excited about? Obviously,
telemedicine. And, the guys at a great VC in Toronto called Portage has a really good telemedicine. They bought that years ago. Like, I think that was going to turn out to be one of their best investments. Paul Demery and Adam Felsky and them, they've done great. I think telemedicine is awesome. I think anything that's pushing a digital transformation, logistics, like everything you just said.
Yeah.
I'm not sure I'm on the boat of, still buying into Peloton, those type of work from home, be home stuff. I think that we're getting to the point where, like, okay, in home is nice, but I need to go somewhere and do something. Look, what I'm going to assure all of you is this will pass. We will meet again. We will be outside. It'll all come together. I very much do believe that we're going to have a vaccine. I think we're going to change the framework of how we go and do things. I think we're going to have to prove our vaccinations for the first time in our life at a scale level, as in, going up a building, you're going to need that, not just ID. I think it's going to get a lot more intense in 2021 and 2022 around how healthy are you? Can you get on an airplane? Can you do this? I think that's going to be a paradigm demanded, but it's going to get difficult because if we screen everybody in a certain way, then you're going to find a lot of empty seats on an airline, right? So
yeah, absolutely.
It's going to be interesting. They got a question here about the BTC.
Yeah, Chris really wants to know if you're using Bitcoin as a hedge, if you believe in the inflation theory and how you're using it as a hedge.
I own a bunch of Bitcoin, quite a bit actually, and I'm not selling it. And look, you're not going to love this answer, because people that talk about Bitcoin are really about Bitcoin. People love gold, only talk about gold, which I don't like. I'm more Warren Buffett on that. Bitcoin, I don't like it. I have it because I think it's a bit of a FOMO, and it's a bit of I'm going to sell you something that I don't think is valuable. Look, the problem with Bitcoin, there's a million problems with Bitcoin, but the main one is it's just not big enough. It's not important enough. I know you want to hear how this is going to be. There's all these things about the Fed printing too much money, but it's anti-inflationary because Bitcoin can only do this and that. But for the fact that the US Fed is the Federal Reserve currency for the planet, and it's backed by something called the United States, which is probably worth hundreds of trillions of dollars as an asset. It's backed by the US military and everything else. So those are real mistakes. Bitcoin to me is not nearly as valuable for a number of reasons. And I'll just give you a couple. I don't know, 1,000 people control it. That's not a currency. Just 1,000 whales, maybe less, control the price. That's an oligarchy. I don't know what that is. I'm not bullish long-term on it, but I do own a bunch of it because yes, I'm going to trade it and make money on it, but I don't believe in it.
Yeah, that's a fair answer. I appreciate that. All right. Well, thank you so much, Michael. Really appreciate you hopping on with us. And everyone, This will be available online on YouTube and Spotify for you to listen to later on. So thanks so much for joining us, and take care.
Be well, everybody.